Welcome to the MUFG Global Markets Podcast. I'm John Cook, and I'm joined today by George Goncalves, MUFG's Head of U.S. Macro Strategy. It's Tuesday, October 31st, 2023. Welcome back to the podcast, George, and a happy Halloween to our listeners.
Thanks, John. Good to be back. I think this is a first. It might be maybe one of our scariest podcasts too, tongue in cheek.
Yes. Nice little Halloween reference there. So again, to our listeners, we are recording this on Tuesday, this episode rather, on Tuesday, October 31st, which is Halloween. It's also the end of the month, which means lots of index extension activity, and plenty of activity just in general. The Bank of Japan just kind of surprised markets, but also underwhelmed markets by making yield curve control a little bit more flexible, as you mentioned, could be the scariest podcast yet. But I guess keeping on this theme, what has you fearful at this point? I think we've discussed in recent episodes, sort of your view that that higher rates eventually break something. Why don't we talk about some of the risks as we head into the end of the calendar year?
Yeah, no, John. So as we all know, today is month end, and we have 2 months to go. Right, we have 2 months to go until the year end, and so I think one of the biggest kind of concerns I have as we narrow down and close out the year is that this is typically when liquidity becomes more precious. Balance sheets are harder to come by, and that sometimes creates uneconomic outcomes. And markets do things that just really sometimes defy logic, but in the end, it really comes down to the availability of liquidity and just the pricing mechanism when there's less kind of activity as the year comes to an end. So I think it's really a combination of things. This higher global rates story, I think, will persist, although I do think we're getting to levels that are starting to become more attractive, which is one of the reasons why it's a bit difficult for rates to stay up, especially in the intermediate sector. We've kind of flirted with the 5% level a number of times and really don't stay there for too long. So it's really unfair to say that we've actually seen 5% if it's only for like 5 minutes intraday. I think I'd like to see a multiple day closing of 5% or higher, allow the markets to digest that and see what that means for other asset classes. But nonetheless, higher global rates in the U.S. really kicked it off by the bear steepening that has been our call since the summer. I think that with higher term premium is going to really leave an imprint on other asset classes. And then, as you also mentioned, the news that we got overnight as well about what Japan did with their minor tweaks to YCC is also resulting in higher rates locally in Japan, which again, the idea of the birds of a feather flock together. Global rates are fungible. Investors around the world can pick and choose, and Japan investors themselves can determine to keep capital at home instead of actually allocating towards Treasury. So I think all of this stuff gets much trickier from here into DEES 31. And central banks, I don't think, are going to turn and get constructive or helpful to the markets until something does break. So we're kind of stuck in this, what we'll get to in a moment, this higher for longer paradox, that the longer we're at high rates, it just ensures that we're going to likely see a more negative outcome, and that we really can't sustain high rates because we're a leveraged system. And from the flip side, from an investor standpoint, those that do have cash and have an ability to buy on dips and get cheaper bonds, I do think that we are, especially when we see these back up in rates, both in Japan as well as in the U.S., like this higher global rate story. If you have excess cash, this is a time to kind of average in. I think that these are getting to much more attractive levels in the bond market. But again, because it's been such a rough year this year, and it's the third year in a row, most likely, that we're going to see losses in bond markets. This is something bond investors have really never dealt with. And so it's understandable why there's a reluctancy to actually allocate capital here, being hurt year after year. But that's usually the time where you're supposed to be averaging into securities, buy low and sell high, right? So I feel like this is where we are. Understandable why people are holding back, but I do think that we're getting to attractive levels. But it's kind of like you need the global high rates in order to actually expose that the macro conditions can't survive at high rates, and which then would result in eventual rate cuts in the future. But you kind of have to see one happen before the other.
Yeah, that's a delicate dance there for sure. And this is something you spoke about in your recent macro to markets report, titled, if I'm not mistaken, the higher for longer paradox. In that piece, you have a specific topic on core inflation. You rehashed your housing views, which you covered in an earlier piece, as well as I think last week's podcast. And you also give us your medium and long-term view on, fixed income treasuries, as well as the Fed. Covering a lot of ground there, a number of topics. But why don't we pick a few of them to go over for our listeners' benefit here on the episode?
Sure. Yeah. I mean, without going into all the details, again, this higher for longer a message by the Fed, and I think most central banks are going to try to do the same thing. Really ignores the long and variable lags of tightening. It suggests that higher rates won't really impact the economy, but then you start to ask why raise rates to begin with. It assumes that eventually, if they have to cut rates and engineer a soft landing, they're going to do it slowly. And to me, that's a lot of assumptions right there and then. And this idea that higher rates don't matter has been a theme that's kind of really irked me for quite some time. This idea that rates don't matter. We keep hearing it every so often. They do matter, especially in a world that was for 15 plus years at low rates, and it really locked the overall system with fixed rate bonds at much lower yields, and now their prices are deeply underwater. So there's been even if it's not a realized loss, there's unrealized losses in the system, and that changes behavior for the system. Banks have been holding back on credit, and that by extension is kind of how the channel is supposed to work. The providers of credit and liquidity, they pull back, that slows down the economy. The Fed is still having its monetary policy effective. There's a lot of people that are been having second guesses, like, oh, monetary policy is no longer effective. I think it's just the lags are just taking much longer, and we're impatient around that. But I do think that this higher for longer paradox will resolve in eventually the Fed having to cut rates. It's just a matter of time. And so we kind of go into those topics. We also kind of go into why, if maybe we're wrong, like why we would be wrong, or more succinctly, that we're more than happy to change our bearish views if we really do see a number of conditions met. And again, without spoiling it, it's a long list, and I don't think we're anywhere near achieving some of these things. We're, I think, a long ways off before we get Fed cuts, which would be what you should be doing right now. So if central banks are forward-looking, they should start to kind of foam the runway to kind of slow the economy into a soft landing. The way we're going at full speed, high rates, we're going to increase the odds of a recession. So that, plus a whole host of other things going on globally, is why I still stick with our view that we're likely going to skip the soft landing and go right to a more harder landing. But there's still time to change it, and I'm more than happy to change our view if the conditions change.
Okay. Yeah, it seems reasonable. We covered a lot of ground there. We obviously have the FOMC meeting tomorrow. It's been a really busy week. We mentioned the BoJ tomorrow, which is going to be today for most of our listeners. We get the Treasury's refunding announcement. We get the announcement from the FOMC meeting. We've got the Bank of England on Thursday, and then we've got non-farm payrolls on Friday. Why don't you tell us what you're expecting specifically from the FOMC meeting this week, but also from a number of the other key risk events?
Yeah, no, that's right. This is a big macro week following even last week too. So I think this sets the tone for the month. And as we know, this is also a holiday month. The next month is also another holiday month. So people are going to be in and out. And I do think that the first couple of weeks of November really sets the stage for the month, and then really for the end of the year. So I think this is super critical. BoJ out of the way, but I think we're going to be digesting it for a number of days. Up next, at the time of probably most people listening to this, will be the Treasury refunding, which has taken on a greater importance, and of course the Fed, and then we have the payroll numbers, but at the end of the week. So a lot to kind of chew through. Just really quickly to wrap it up, the quarterly refunding announcement, which now has its own nickname, the Q.R.A. People are calling it. I've been doing this for 25 years, and people never really called it the Q.R.A. like that. So it's kind of interesting that we've shorthanded it already and created an acronym. But it really goes to show you that the broader markets out fixed income are now focused on Treasury supply. Like for years, people were not focused on it, but now because of higher rates, the higher interest cost on debt, and just these large deficits, everyone outside of fixed income is also really having a keen eye on what's happening with supply. That comes out at 8:30, and I think that there's still going to be a need for the U.S. government to keep terming out its debt, and it's not as if deficits are going to go away and spending is going to stop overnight. So I do think that the supply story is probably going to overshadow the Fed meeting. I've gone as far as saying that in a weird way, the bear steepening and the term premium coming back into the Treasury curve is doing the tightening for the Fed. So in many ways, this is like and we've heard even from Chair Powell at the last New York Economics Club event that that he's kind of like almost outsourcing this their policy. As long as long-term rates stay high, the bond market's doing the tightening for the Fed, so they don't have to hike. So we don't think they're going to hike at this meeting. Actually, we think, and we've been of this view really since July, that both the bear steepening and tighter financial conditions would result in the Fed not hiking again, and that the July meeting probably will go down in history as the last hike. But too soon to kind of put that in stone. I think we need to get through this meeting and see what Chair Powell says for the upcoming December meeting. Does he keep it live? Probably does. There's no reason to take it off, but it's going to be about the body language and the tone of the messaging, because we're not going to get economic updates or forecasts from the Fed. This is an intra-quarter meeting. So I think probably the best we'll get is another hawkish skip, no hike, keep the December hike open. But if it's not said with conviction, probabilities will keep dropping to zero.
Okay, heard it here. So hawkish skip, but keep December and also January open. If I recall correctly, I think that's where we still have peak funds. So again, for our listeners' benefit, definitely check out George's latest desk strategy report, the macro to markets outlook, quote unquote, the higher for longer paradox. And again, for our listeners, for you who are not receiving George's strategy reports, please do get in contact with George or your sales coverage. Great stuff as always, George. Looking forward to see how the FOMC and the rest of the this week's risk events play out. Thanks again for coming on the podcast.
Thanks for having me, John.
And thank you for listening to the MUFG Global Markets Podcast. Rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts. And reach out to your MUFG sales rep for any further information. Check back soon for more insights from the Global Markets Research Team.